Well, folks, we got quite a market on our hands. We have stocks skyrocketing. We have bad news come out today. People are like, what in the world is going on? How is bad news equal stocks go flying high? Okay, we're going to talk about where this market's headed, why this is happening, and how investors should kind of prepare for a market like this, and kind of how you should be positioning and those sorts of things. So a lot to go through in today's video. I just want to get straight into this, guys. I appreciate y'all being here as always. Thanks for being subscribed to the channel. Okay, so I'm sure you have looked at your portfolio today, and it's probably very nicely green. Palantir's up over 5% here today. Good old Tesla Maslow's been up anywhere from 5 to 6% most of the trading day. Even the Planet's making a nice move here today. Elf on a Shelf up nearly 9 percentage points here today. Move after move, right? The public account's having a great day. We're up $57,000 in the public account here today. A lot of big movers in that one. Tesla Maslow's up $23,000 today. Elf's up $11,000 today. Meta's up $11,000 today. Palantir's up $4,500. Even flipping Flapjack and PayPal's up. Do you know how much the market has to be like in a good state for PayPal stock to go up? This stock never goes up for me. I mean, holy smokes, this ain't no dang joke. So nonetheless, you should be making some money out there today. Even the dividend portfolio is actually up. This account's been just trash for the last several months now at this point in time. This portfolio did very well last year when the market was getting hit heavy and no one wanted to grow stocks, but now the dividend portfolio just like has been horrible, but even this one's eking out some green today. Nvidia's making another big run. I can't wait till all the people that say Nvidia's overvalued are paying $1,000+ for that share and they're jumping over themselves. That's going to be quite an entertaining thing. I'm just waiting on that whole situation. Okay, so what's going on here? Why are stocks flying high today when we have a situation where it looked like bad news came out? Okay, so let me explain this and kind of get into this in detail here. Alrighty, so first up, the reason the stocks are going up is treasuries are going down, okay, especially on the long end, which is kind of, let's just think about it here. These are all going down here today. And the market's been pretty simple recently. If treasuries, or especially the long end, if treasuries are going down, then stocks are going up, and vice versa. If the long end's going up, stocks are going down. It's been a pretty simple market here recently. But where this gets really fascinating, right, is treasury yields drop after new data shows consumer confidence waning, right? I mean, if consumer confidence is waning, you would automatically assume, well, shoot, man, that must mean recession risk goes up. That must mean, you know, a company earnings going to be as strong. It would usually cause the market to go down and be worried, right? The conference board said its consumer confidence index came out at 106. That was below the Dow Jones estimate of 116. So we're not talking about a small miss. We're talking about a massive, monumental miss in consumer confidence from this particular index, right? The conference board also said average inflation expectations increase for the next 12 months, which is really from like the consumer level. That doesn't mean it's from the Wall Street level. This is more from the consumer level, okay? Pressuring overall confidence, while the short-term outlook for income, business, and labor market conditions declined, okay? So basically people are expecting the short-term outlook for their income, their business, if they own one, and labor market conditions to decline. Traders also poured through new data on U.S. job openings. The latest job openings and labor turnover survey showed open listings declined to 8.8 million from 9.5 million. They also reached their lowest level since March 2021. Okay, so now it looks like we're starting to see some weakness in the jobs market, right? Now this is fascinating because in most markets, like you would think, okay, this is like potential bad news. Like, why would stocks be flying in the face of this situation, right? Well, normal market, bad economic news equals the market down, right? And good economic news makes the market go up. And this is most of the market. I mean, certainly the first several years of me getting in the stock market, this was definitely how the market approached things, right? Because, I mean, I got started in 08 and into 09, right? And at that time, it was just seemed like bad economic news on bad economic news. And then when we started like bottom out things a little bit and it looked like we were getting some glimmers of hope, the market would go up on these like glimmers of hope of like things are going to get a little better, and it looks like we're going to see stabilization in the banking system and see stabilization in the unemployment rate and those sorts of things, and we're kind of bottoming out, and we should slowly start to get better, right? But this is so opposite of the market we're in right now. We're in what's called a high inflation market. In a high inflation market, it's complete opposite. If you get really good economic news, the market's going down, because if the thought process is, if the economy is too strong, really good, right? Well, that means we haven't killed down inflation. If you haven't killed down inflation, that means Fed funds futures and Fed funds rates are going to go higher. If those go higher, it's going to affect all the treasuries. It's going to affect all interest rates in general, which means car loans are going to get higher, which means mortgage rates are going to go higher. The whole dang thing's going to go higher, which means you're likely setting yourself up for a deeper, darker, potential hard landing type recession scenario the more and more you push interest rates. The more you push interest rates higher, the more you're likely going to have systemic problems in the banking system, the more likely you're likely going to have a credit crunch, and the more likely you're going to have a devastated economy at some point down the road when those Fed lags catch up, right? So we're in just a complete opposite market right now where it doesn't want this situation, right? Now, 2011 through 2015, we had a market, and I remember back in those years, it was kind of like we wanted everything to be like good and getting better, right? But we didn't want it to be too good. And this is where you get into the higher level games of chess that the market plays, right? Because just like right now, we don't want a horrible economic news. We want like just economic news that's weakening, but we don't want it to be a disaster. And so I remember the market from 2011 to 2015, we wanted things to get better, but we didn't want it to be too good. And the reason the market didn't want it to be too good is we still wanted quantitative easing. The market wanted quantitative easing. The market wanted rates at 0%. This is what the stock market wanted. So if there was ever a report or something that came out that it looked almost like too good, the market would actually go down in that time period just because everybody was so addicted to quantitative easing and so addicted to these 0% interest rates that they're like, we don't want this right now, okay? And so in this market right now, like let's say hypothetically, right? This isn't very realistic, but let's say the job opening number came in as 0, or let's just say 4 billion or 5 million or something like that. I can tell you the stock market would have absolutely crashed today. It would have been an epic, colossal crash here today. You may say, well, why? That would have been, economy getting worse. Like, wouldn't that be seen as a good thing, right? No, not that level. Because we're trying to play a high-level game of chess here where we want things to deteriorate. We want things to get worse, but we don't want it to become a disaster. That's where the market's trying to avoid right now. It's trying to avoid too good of an economy. If this number would have came in at 9.7 million, the market would have crashed today. Do you know why? Well, because that would have meant inflation expectations are going to go higher than ever, which means Fed funds rate is likely going to go way higher, and we're not even close to being at the top yet. And I can tell you if that happened, the market would have been freaking out today. So a result like this is the best case scenario that could have happened for the market. At the end of the day, like if this number came in way too low, the market would have crashed. If it came in way too high, the market would have crashed. We need to see slow deterioration. Remember what the market's aiming for. The market's aiming for the soft landing. Okay, you've probably heard the term a million times. This is what the market wants. A situation where all the economic numbers deteriorate, right? We slowly get inflation out of the system, month after month after month, right? And ultimately, we're able to set the economy up so it can keep trucking along. We don't see unemployment skyrocket in any way. Maybe it goes up a little bit. Maybe we go to 4% or so, but we don't see any sort of disaster. We don't see a banking collapse. We just see this kind of soft landing scenario where everything gets a little worse, but not too bad. Okay, and it's not an easy thing to pull off, right? Some would say it's threading a needle in this situation. If we didn't have a soft landing, that means there's a lot of devastation obviously coming to the stock market, right? Now, a hard landing, this would be a disastrous situation. The market does not want to see this. And you might say, well, this would be great because this would get rid of all inflation. Yeah, and we would have a whole lot bigger problems at that time than inflation, I can tell you that. If you have a hard landing, okay, here's what you're going to see. Unemployment's going to soar in a massive way. Hours, for people that are on hourly jobs, which we know there's a ton of Americans that are on hourly jobs, right? Hours cut big. Anybody that was in the workforce 2008, 2009, 2010, you know how it was tough to get hours. I remember, at Einstein Bagels, I remember at Walgreens, it was difficult to get hours, even as like a guy that was making barely above minimum wage just to, I almost fought a guy one time just to get more hours. Like it was tough back in those days, okay? If you weren't around, you don't even know what I'm talking about, but I'm telling you, it was tough to get hours back then. Very, very difficult. I mean, you were lucky if you get an extra 5 hours from your workplace. It was like a blessing. It was crazy, man. In a hard landing, you're going to get deflation. Now, some people might say, oh, that sounds so amazing, deflation. Housing prices go down and rents go down, and I could pay cheaper price when I go to fill up my gas tank at the local gas station. This sounds amazing, okay? No, it's not amazing when you don't have a job. It's not amazing when you're making 40% less because your hours just got cut 40%. None of that's amazing, okay? So it sounds great in theory, but just ask all the people in the great financial crisis that lost their homes, that lost their jobs, that got their hours cut big, that ask them how that deflation was, okay? They're going to tell you, hell no. I'll deal with inflation any day of the week over that crap. That's a whole different situation there, okay? Government debt soars if you have a hard landing, right? So everybody talks about the government debt and these debt levels. Well, guess what? We have a hard landing. You ain't seen nothing yet in terms of government debt. You wait, 40 trillion, 50 trillion, 60 trillion is on the way. If we have a hard landing, I can tell you that much. It would soar like it's never soared before, okay? Get ready to see $100 trillion in government debt. That's where it'd be going if we get a hard landing, folks, okay? You have bank bailouts that happen. That's a whole situation to deal with, right? Then you have a credit crunch that also happens, right? And then you got a massive new mess to clean up. A massive new mess. This is why it's so important to have a soft landing and not a hard landing, because this is a disaster cleanup. This does not happen overnight. This takes years to clean up. Years, okay? As what happened in the great financial crisis, it took 5 years for the real estate market to really bottom, right? We've topped real estate prices 06, 07. We didn't bottom until 2011, folks, okay? People didn't feel like the economy was really starting to get in a decent place again until 2012. And the devastation started in 08. This is how long it takes, folks, okay? Long time. You're talking years. And you're talking about debt loads like, whole new levels, okay? We can't have a hard landing. The market can't have a hard landing. You're talking about people's 401ks getting hit 30, 40, 50% in that sort of situation. Devastation. This is what we're aiming for. Now, when it comes to Fed, this reminds me of being a receiver or, a quarterback in high school, right? You might be wide open for that catch. And this is a Fed in most years. They got a pretty easy job. The economy is just getting a little better. Inflation's usually under control. And their job's not very hard most years, okay? Then it's kind of like going to college. And things get a little more difficult. It's a little more of a serious game. Now, this reminds me of kind of like the Fed in 2009, 2020, 2022, right? Where it's still easier than the next level, but it's still a little bit difficult, right? But at the end of the day, 2009, the economy had been devastated, so it was pretty obvious to the Fed they got to keep rates low, if not at nothing, right? And, money printers go burr. At 2020, pretty obvious situation there. Obviously, it was an ugly situation where unemployment was skyrocketing, but the Fed kind of knew what to do. 2022, inflation's going out of control. Raise rates, raise rates, raise rates. There's not really a question around that, right? So it's like things get a little more difficult, but there's still like clear what you should be doing in that sort of environment, right? And the next level is like the NFL level, right? Now, this is where things get really difficult. Years that remind me of like NFL level are like 2007, right? Where the Fed was convinced we weren't going to have a recession, where you heard the president of the United States at that time say we're not going to have a recession, the government in general, we're not going to have a recession, right? And it was more of a confusing time because you were getting some economic signals that were maybe a little bit troubling that were happening. You had oil prices start to really, go up in a major way, 07 into 08. And so it was a very kind of confusing time, and I feel like that was a very difficult year for the Fed to make decisions, and the Fed ultimately really didn't lower rates fast enough in that situation. Next thing you know, we had a great financial crisis, right? 2023, I think it's a really difficult year for the Fed to make these sorts of decisions, right? They're looking out there, and they're seeing inflation higher than they want it to be still, but at the end of the day, you're seeing the economy slowly start to deteriorate, right? Keep it pretty base level. A lot of times people overthink this stuff. If Apple is having trouble growing revenues, if Apple's revenues are going down, do you think we're in a tougher economy or not? Yeah, if Apple can't grow revenues, we're probably in a little bit of a tougher economy in that certain time period, right? This is something to kind of keep in mind. And you look at the growth rates of many of the best companies in the world over the past, several quarters, they've been very bad, to be quite frank. So that's clear, we've had an economy kind of, getting a little worse, and these job opening numbers, things like that, can kind of tell a little bit of a story as well, right? I think 2018 was a really difficult year for the Fed to make decisions as well, right? That was a year the Fed started to try to raise rates, right? And T-Man came out and basically said, nah, you guys shouldn't be raising rates right now. That set a new precedent because usually presidents don't really comment on what the Fed's doing. And for him to come out and make comments and say, you guys shouldn't be raising rates, lower rates, it's a bunch of crap. That was a big moment in time, right? And there was a moment where the Fed backed down, actually. Jay Powell and the Fed, they backed down. They backed down in that situation. And I don't know if they really should have. Obviously, with what happened in 2020, no one could have really foreseen that, unless it was planned, in that whole situation, right? So the Fed's jobs is just difficult in certain years, much more difficult than other times. And I feel like right now, they're in a tough time period. Because if they take rates too high for too long, they're going to set us up for a hard landing. And boy, are they going to have a mess to clean up on the other side, okay? And this is why they have to do it just perfect. They have to, but the problem with this Fed, and the reason I have some doubts around them, and we'll talk about kind of, my approach in this market and how investors should be approaching this market in my personal opinion. But the reason I have some doubts around this Fed, and the reason I'm a little concerned if the soft landing is actually going to happen in 24, which the landing is going to happen in 24. Whether it's a hard or soft landing, we'll see, but the landing is going to happen in 24. The reason I have a little bit of doubts is because this Federal Reserve, Jerome Powell and the whole bunch, they aren't really looking to the future. They're looking more at the past. They're very data dependent. And you say, well, data dependent might be a good thing. Sure, but the problem is you're looking at the past. If you're looking at data, you're looking at old stuff. You're not projecting out to see where the future is going, right? And no different than think about it. If you're a CEO of a company, where are you looking? To the future. The past can tell you a little bit, but ultimately you're looking to the future. You're trying to figure out where the market's headed, where your business is headed, where the industry's headed, right? You're all thinking about the future. If you run a tech company especially, you're thinking about the future every day. You wake up, you're thinking about what do people want for products and services over the next year, 5 years, 10 years, okay? We have a Federal Reserve who doesn't even think about the next 5 weeks. They're thinking about the last 5 months. And that's where we get into this kind of trouble. And I think about the Fed lags, and I kind of have some major concerns about if the Fed can engineer a soft landing, because we already seen them screw up once. They didn't look to anybody in the real world that was running businesses knew inflation was already starting to go wild at the end of 2020 into 2021. The Fed never saw it coming, right? And by the time they started to raise rates, inflation was already out of control. In 2022, right? They started raising, March 2022, April 2022, something like that, right? Inflation was already out of control by that time. So if they keep raising or keep rates too high for too long, it's a possibility we could already be in a hard landing by the time they're making decisions to try to end the hard landing. But then you're still got another year or two of pain to go through before that problem's then fixed, right? No different than we're still dealing with inflation that's too high right now, when this could have been done a long time ago. If the Fed had if the Fed had just slowed down their craziness in 2021 when they should have been, and if they had obviously made some decisions to, start raising interest rates, we never would have had inflation as insane as it went in 2022, right? Sure, we might have had a little bit of a slower economy, but I don't think that would have been a bad thing, especially when you think about what we've had to deal with recently. So that's kind of some food for thought there, okay? Now let's talk about how investors should approach this market, in my opinion, kind of how I'm approaching this market and how I think about this market in kind of everything we're dealing with here, right? So the way to think about it is if you got a smaller amount of money, it makes sense to not even worry about this stuff and just buy and buy and buy if you're dealing with smaller amounts of money. Now, if you're talking about little larger amounts of money, I think it's very important to have some cash levels around, 10 to 30% cash in this market. I think this is not a stock market you want to be cashless. Let's call it that. I think if you want to go cashless last year in that crash scenario where the best stocks in the world, where Nvidia was trading at $110 and Meta was trading under $100 and Tesla was trading at $100 and AMD was at $55, I think if you want to go cashless last year and just deploy every dollar you possibly could in the market, I think that was fair game. But I don't think this is really the market right now that you want to be cashless. I think this is a sort of market you want to have 10 to 30% cash around, especially if you have bigger amounts of money. because there's a lot of different scenarios that can play out here. If you are going, if you have no cash right now, then you're basically preying on a no landing, a soft landing, okay? And I don't think it's necessarily a great idea to hope that these guys pull off something that they might not be able to pull off, okay? And so that's why it makes sense to be net long, like I am in the market, but have some dang cash around. If you're a more sophisticated investor and you have a lot more experience in the market, then you can consider some hedges for next year as well, which is, certainly a pretty good idea if you're somebody that's more sophisticated. If you're in your first, few years of investing, does it make that much sense to hedge? Probably not, because you're not at that level yet. If you've been in the market 10, 15, 20 years, it's a whole different ballgame. You know what you're doing. You know how to set up some hedges, some proper hedges for your portfolio, just in case we get that hard landing in 24 or something like that happens. Hey, you're prepared for it, and you're going to make a whole lot of money on the downside in that scenario. But at the end of the day, if you got larger amounts of money, you need to be having cash around. I'm telling you, have a little bit around. And especially right now. In the past, if you had cash around, right, let's call it the previous 15, 20 years, you might look at it and you say, well, dang, I got cash in a savings account, it's not earning me anything. Right now, you get 4 or 5% on that cash for sitting over there right now. So we're in such an opportune time to have a little cash around, right? I'm still buying stocks every week. There's a lot of deals out there. I'm going to continue to take advantage of deals, but I'm also cashing every single week, right? This is the right approach in this market, in my personal opinion, that we're going into. Have some cash over here. If you're sophisticated, have a little hedges and be long the market and take advantage of deals in the market. It's a kind of a threefold strategy there. And I think that's the best approach in this market, man. It's the best approach. Certain markets, it's like just buy. Don't worry about cash. Don't worry about anything. It's just you need to be taking advantage of every deal in sight, okay? This market, take advantage of deals. Also take advantage of that 4 to 5% you can get in a savings account right now. Okay, cash up a little bit. Okay, appreciate everybody joining me as always. Much love. Thanks for being subscribed, folks. If you're looking to apply to join my private group and learn everything I got up here that I've learned over the past 15 years of investing in the markets, in the money game in general, then apply to join my private group. That will be the pinned comment down there. Much love and have a great day.